Case open. Nobody is driving the economy. Not the president. Not the banks. Not some room of men in suits with a big red button. The thing that decides what your rent costs, whether your job still exists next year, and what your savings will be worth 20 years from now. That thing has no driver, no steering wheel, nobody's hand on it. I went into this case looking for whoever was in charge. I assumed I'd find them, because every system has someone at the top. Instead, I found something much stranger. Most of the money sitting in your bank account right now was never printed by anybody. It was never minted, never pressed, never touched by a machine. It was typed. And once I'd found out who does the typing, the economy stopped looking to me like a machine and started looking like something much closer to a religion. Let's set the scene properly, because there's one piece of background you need before any of the clues make sense. Ask most people where money comes from and they'll tell you the government prints it. It's a reasonable answer. It's also wrong, and not slightly wrong. It's wrong about almost the entire supply. Physical cash, the actual paper notes and metal coins, is a tiny sliver of the money that exists. In the United Kingdom, the Bank of England puts it at around 3%. 3. Everything else, the other 97, is numbers on a screen. Numbers in your banking app. Numbers in your employer's account that become numbers in your account on payday. Numbers that pay your rent, buy your groceries, cover your medical bills, and have never once existed as a physical object anywhere on Earth. So, there's a hole in the story. If the government is only responsible for that 3%, somebody else is producing the other 97. Somebody is making nearly all of the money in your country, and it isn't the mint, and it isn't the treasury. The suspect is hiding in the most boring building on your street, the one with the beige carpet and the pens chained to the desk. Clue number 1. And I want you to actually sit with this one, because it took me 3 readings before I believed it. Here's what almost everybody thinks banks do. You deposit $1,000. The bank keeps a small amount in reserve and lends the rest to somebody who needs a loan. The bank is a middleman, a warehouse with a front desk moving existing money from people who have it to people who need it. That's the version in most school textbooks. It's called the money multiplier model. And if you ever took an economics class, you probably drew a little diagram of it with arrows. It is not what happens. It is not even close to what happens. When a bank grants you a loan, it does not go looking for anybody's savings. It does not check the vault. It opens your account and it types the number in. That's the ceremony. That's the whole thing. You borrow $300,000 for a house. The bank writes $300,000 into your account and in the same instant writes down that you owe $300,000. 2 entries created simultaneously, balancing each other perfectly. Neither of them existed 1 second earlier. And the money you then hand to the person selling you that house is brand new money. It did not come out of anybody else's account. Nobody, anywhere, has less because you have more. The total quantity of money in your country just increased by $300,000 because a loan officer clicked approve. At this point in the investigation, I was certain I was misunderstanding something. This has to be a fringe interpretation, I thought. So I went to the source. In 2014, the Bank of England, the central bank, the actual institution, published a paper in its quarterly bulletin, and it says this in plain language, almost impatiently. Banks do not lend out deposits. Lending creates deposits. The textbook diagram has the arrow pointing the wrong way. They published it because so many people had it backwards, including a very large number of professional economists. So banks don't move money around. Banks make money, not as a figure of speech. Literally, in the sense of bringing into existence something that did not exist before. And there's a mirror to this that hardly anyone mentions. If a loan creates money, then paying a loan back destroys it. When you make that mortgage payment, the money doesn't travel into a pile somewhere. The 2 entries cancel each other out and it's gone. Every single month, all over your country, money is being conjured into existence by borrowing and quietly annihilated by repayment, and the amount that exists is simply whatever's left over after those 2 tides meet. Which sounds like an unbelievable superpower to hand to a private company. And it would be, if only one bank had it. But that's precisely where I had the case wrong. Clue number 2. There isn't one bank doing this. There are thousands of them, and every commercial bank in your country holds exactly the same pen. Thousands of institutions, each deciding independently, millions of times a year, whether to type a number into a stranger's account. There is no meeting. Nobody phones the others to coordinate. A loan officer in one city approves a small business loan on Tuesday morning, while a mortgage desk 400 miles away turns down a young couple that same afternoon, and neither of them knows the other exists, and both of them just moved the national money supply. So the amount of money in your entire economy is not a quantity that somebody sets. It is the sum of millions of separate private guesses about whether the future is going to be okay, which means the money supply isn't really a number at all. It's a mood. When banks feel confident, when unemployment looks low, when property prices look steady, when the people walking through the door look like they'll pay it back, they type more numbers, and there is more money in the world. When they get nervous, they stop typing. Loans get harder to get. And here's the consequence that follows automatically from that mirror I just showed you. Old loans keep being repaid, and repayment destroys money. So if new lending isn't replacing it, the money supply is actively shrinking. Not because anybody decided it should, because a few million people got cautious at roughly the same time. Now I can hear the objection, because I had exactly the same one. Surely somebody is watching this. Surely there are rules. There are, and they're real. Banks can't type infinite numbers. They need capital, their own money genuinely at risk, sitting behind their lending. They answer to regulators. They face reserve requirements, stress tests, capital ratios, and the extremely practical fear of not being paid back, which is the strongest break of all, because a bank that lends badly dies. But look carefully at what a break actually does. A break limits how fast you travel. It does not decide where you're going. Every one of those rules constrains the typing without ever directing it. Nowhere in the system is there a person or a committee deciding how much money your country ought to have this year and then producing that amount. And that's the moment the investigation turned on me. Because if all of this money is genuinely just promises stacked on top of promises, held up by the belief that they'll be honored, then what happens on the day people stop believing? Clue number 3. And this is where it stops being an abstraction, because we have watched this happen repeatedly within living memory. September 2007. Northern Rock, a British bank. Rumors spread that it was in trouble, and people did the only rational thing an individual can do in that situation. They went to take their money out. Queues formed down the pavement outside branches, in the rain, in a wealthy modern country. It was the first serious bank run in Britain in roughly 140 years. It was filmed. You can still watch it. Here's the cruelty buried in a bank run. Every single person standing in that queue is behaving sensibly. If your bank might fail, getting your money out before everyone else is the correct individual decision. But the money isn't there. It was never there. It was lent out, typed into other people's accounts, spent on houses and shops and business equipment years earlier. A bank that holds everybody's money at the same time has never existed in any country at any point in history. The entire system functions only because we don't all ask at once. So the rational individual act, performed collectively, destroys the exact thing that everyone in the queue is trying to protect. Go back further and it gets much worse. In the United States, between 1930 and 1933, roughly 9,000 banks failed. Not 9,000. Savings that ordinary people had spent entire working lives accumulating simply stopped existing. Not stolen, not misplaced, gone, because the promises underneath them stopped being believable. And once that happens, there is nothing else underneath. That is the direct reason deposit insurance exists today. It wasn't dreamed up by economists at a whiteboard. It was built out of the wreckage, engineered specifically to interrupt the psychology of the queue, to give the person standing in the rain a reason to go home. And then 2008 gave us the adult version. Lehman Brothers collapsed in September, and the freeze that followed wasn't fundamentally about buildings or factories or oil. Banks stopped believing each other. They stopped lending to one another overnight, because nobody could tell who was holding what, and any counterparty might be dead by morning. Credit seized up like an engine without oil. And then people who had never heard the phrase collateralized debt obligation lost their jobs, and then their homes. That's the human cost of a mood. I'm not being poetic. A mood, moving through a network of strangers, arriving at your door as an eviction notice. So let's answer the case. Because there is one suspect left, and it's the obvious one. What about the central bank? The Federal Reserve, the European Central Bank, the Bank of England? Surely that's the driver. No? And this is the revelation. A central bank does not have a steering wheel. It has a lever. It can make borrowing cheaper or more expensive. That is essentially the entire instrument. It moves an interest rate, and then it waits and hopes that millions of strangers respond the way it expects. It cannot force a single bank to lend. It cannot force a single person to borrow. It can make money almost free and then watch nobody reach for it, which is precisely what happened for years after 2008 when rates went to nearly zero and lending still crawled along the floor. Because you cannot make people feel confident by making debt affordable. Confidence isn't for sale at any price, and the lever is slow. Economists have a phrase for this: long and variable lags. You pull the lever today, and the effect arrives somewhere between 1 and 2 years from now, in an amount nobody can predict in advance. Picture steering a ship where the rudder responds sometime next year by an unknown amount, and you only discover whether you overcorrected long after it's too late to undo it. That is not driving. That is standing on deck shouting suggestions at a vessel with 1,000 tiny rudders and no captain, where every rudder is held by somebody who has never met anybody else holding your rudder, and where every one of them is watching the others for the first sign of panic. Because that is what an economy actually is. It is not an engine that somebody built. It is not a system that somebody runs. It's the accumulated weight of everyone's belief about tomorrow, your landlord's belief, your employer's belief, the belief of a loan officer you will never meet who decided this morning that a stranger seemed good for it. Every one of those beliefs is a small vote. The sum of the votes is the thing we call the economy, and the votes are recast every single day by everyone, forever. Money is not a substance. Money is a promise that enough people agreed to take seriously. Your salary is a promise. Your savings are a promise. The number glowing on your screen right now is a sentence that millions of strangers have quietly agreed to keep finishing, and the whole structure stands up for exactly as long as we keep agreeing. So let's close the file. 1. Almost all money is created by ordinary commercial banks, typed into existence the moment they grant a loan, and destroyed again when that loan is repaid. 2. Nobody coordinates them, which means the money supply isn't a policy, it's the sum of millions of private guesses about the future. 3. Central banks can nudge with a slow and unreliable lever, but there is no wheel, and there is no driver. And I'll be honest with you, I expected to find all of that terrifying. I sat with it for a while, waiting for the dread to show up. It never did. Because if the economy has no driver, then it also has no villain. There is no room. There's no table of people who know something you don't, deciding your rent this morning over coffee. The absence of a driver is also the absence of a conspiracy. What's actually there, underneath all of it, is us. All of us, quietly agreeing every morning to keep taking each other seriously. Which means the thing holding up the entire global financial system, the thing sitting underneath every salary, every mortgage, every price you have ever paid in your life, is the least sophisticated force in existence. Trust, between strangers, renewed daily by people who will never meet. It is fragile. We watched it break. But it has also carried billions of people through centuries, and it gets rebuilt every single time by nothing more impressive than ordinary people deciding to believe each other again. Case closed. If you want the next case in your feed, hit subscribe. The file's already open.